Something very interesting is happening in the market and we need to be paying attention. Dip buyers bought the dip, but it wasn't semiconductors, it was everything else. What has been the leader this year finally took a back seat in what looked like a rally that would never pull back. So is this just a one-day thing, or are we starting to see market breadth fundamentals improve? Today, we talk about that and yields. Tomorrow, we have a critical 10-year bond auction, and the strength of that auction is going to truly determine where stocks go next. So with the S&P 500 dancing with the 5,000 level, today we're going to be taking a look at the seasonality and hidden divergences and discuss what that means for the market looking forward. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. Pretty rough day for semiconductors, but if this sector has taught me anything, it's the dip buyers will keep on buying the dip. Technology as a whole didn't perform. Apple kind of was the best performer in technology in terms of the size of it, but pretty good breadth everywhere else. I mean, comm services, it's the big boys, the Mag 7. They just didn't participate today, but you know, everything else, defensives, healthcare, energy, real estate, industrials, basic materials, it was pretty green everywhere else, and a very good day for breadth. And this is what I said last week. It's like, yeah, we can have like 2 to 3 days of thin leadership, but if we get that rotation of breadth in other parts of the market, that's fine. The market doesn't always all have to rally at exactly the same time. Something I do want to note, guys, is that have a look at Disney, have a look at Uber, have a look at PayPal, right? We saw the same thing with Eli Lilly yesterday, with Meta, with Nvidia, Microsoft. All of these stocks are running up into their earnings. You only get that in bullish markets. You don't get that in bearish markets. This is a bull market right now. In bear markets, you know, investors and traders say, hey, I'm going to wait after earnings, see what they are, see what guidance is, and then get in. These names are just rallying into earnings. Uber's up like 7%. Same with Disney. PayPal's up like 4%. Eli Lilly was up 5% yesterday. So this is very euphoric bull market sentiment. Now let's actually talk about earnings, guys. So we got a pretty big day tomorrow. Alibaba before the open, Uber, CVS Health. Then we got PayPal, Walt Disney, Arm. So we got a whole bunch of tech names, semiconductor names, comm services names, China names. This is going to be a very big day tomorrow. But let's actually talk about earnings we had today. Fiserv, Spotify, and Lilly. Now, Spotify actually produced pretty good earnings, a bit light on guidance. Lilly stellar earnings. Look at they beat on revenue, beat on EPS, beat on all of their drugs in the pipeline, I believe. Gave really good guidance. Now, FI's earnings, I thought they were good. The market wanted more. 15 to 17% is what they guided for, 14% in free cash flow. But their revenue was not that great, and I think this is what the market didn't like for Fiserv. Now, I did say that Fiserv is a barometer for what PayPal might do, and what I really want to see PayPal do is give guidance similar to that. 15 to 17% guidance. Let's say they beat on revenue, beat on EPS, guide 15 to 17%, announce maybe a $5 billion buyback. If PayPal do that tomorrow, the stock will be up 20% in aftermarket, willing to put money on that fact if they hit the metrics. But that's the case. If you come in with a huge earnings beat, the market's going to reward you for it. But let's keep going. Market breadth, 453 winners, something like 168 losers. Great breadth across the board. What we do want to see is follow through, and this is the name of the game. Sure, we can have one day of good breadth, but if tomorrow we go back to the technology, semiconductor, Google Meta trade, and everything else is down in the dumps, it's going to be really, really rough. So what we want to see is follow through of this breadth momentum in the other sectors that have been lagging, like materials, utilities, energy, real estate. That's what we want to see continuation throughout this entire week. Now, let's actually talk about the majors. Now, actually a pretty bullish day, despite what the NASDAQ 100 will show you. The NASDAQ 100 is just a concentrated index. Let's be real. The S&P 500 up 0.3%. And the fact that pretty much the entire Mag 7 was down except Apple, for the S&P 500 to put numbers out like that, very, very good. The RSP up 0.6%. IWM, the winner out of all of the indices, and then bonds were doing their own thing. We actually had a 3-year bond auction at this point right here. It was very well received, and then we saw yields rally. Up until that point, yields were very volatile, and then after the bond auction, they actually fell significantly, and as a result, bonds rallied. So very volatile action. Yields are trading like a biotech small cap with 3 drugs in the pipeline. Absolutely crazy with what's happening with the biggest debt market in the world. Sectors, let's talk sectors. So look at this, guys, very similar to C. So we had regional banks and actual dumpster fire. down another 1.24%. And I think this NYCB Bank, I think if it keeps falling the way it has, down 60% in the last 3 days, we might actually see a bank run. People might get nervous. So I'm very, very interested to see what's going to happen right there. They say their liquidity is strong, but we know every bank said that in 2008. But semiconductors, technology, comm services, software, they were the only negative sectors today. Everything from home builders and above were positive. And have a look at the winners. Literally yesterday's losers: GDX, real estate, absolute winners, healthcare, industrials, discretionary. All in all, I think this is great breadth, and we want to see follow through now, guys. We don't want to see this heap at the bottom. We want to see these guys back at the top tomorrow, Friday, for the rest of the week. That's what we want to see. And then if technology and semiconductors can participate too, that'd be great. But if semiconductors don't participate, I don't blame you. Valuations are really stretched in that sector. Let's just be real. Like AMD trading at what, 1,068 times earnings? Crazy. Now let's talk big picture and some swing trades. So this right here is February to December S&P 500 performance after a 10% November to January. So positive previous quarter. What are the returns February to December? On average, this has happened 14 times, 1 loss, 13 wins, average return 14.1% in the S&P 500, and momentum brings momentum. The only loss we had, 1987. The first half was positive, the second half was negative, simply because October was absolutely horrid. That was the Black Monday October, followed by a pretty terrible November. But let's keep looking at the big picture. Last year, we got the Swig Breath Thrust, ZBT. This happened on the 31st of March last year. And essentially what this is just like breath thrusts that we get, where equities go from oversold to overbought in a very short amount of time. Normally, these are very, very bullish, and this is what we can expect. Now, the average median return for 33 signals for the ZBT, on average, 52-week returns, 17.5%. And that leads us to an S&P 500 at the end of March at 48.28. We're well above that. Median returns, 21.17, 49.79. So we're kind of around these numbers right here. Now, if we are to use the post-Great Depression signal, average return 21.07%, median returns 25.1. This would read the S&P 500 at the end of March 2024 at 49.75. This is where we are, but on the upper end, 51.40. Let's keep going. So we got a second set of ZBTs on November, when we had that late October, early November like rally, the 18% plus rally we had in equities. So this is pretty much from November to November. Where's that going to lead us? If we use the average and median, 14.3, 17% median returns, that'll leave us at the end of November at 49.80 and 5100. Not quite that bullish. Using the post-Great Depression signal, 27.7, 22.8 average and median returns. That leaves us at about the 33.50 area. So quite a bit of upside if we are to follow these signals. Just a bit of data I thought I'd bring back to your memory. Like, I think a lot of people forgot that we actually had these, and these are generally bullish signals, and we actually are on track to hit that. Some of these numbers, 5100, 4980, you know, we're very close, if not at those numbers already. Now, looking at small cap earnings, and guys, so this is the S&P 600, 169 companies have reported negative 12.8% earnings growth year over year. And I just want to say something right now. The worst performing sector, comm services, right? Staples, real estate, negative 133%. And I don't even know what that means. Does that mean if you reported $100 worth of earnings last year, this year you're reporting 33 cents as a loss? Crazy. What an actual dumpster fire small caps are. And that's why they trade at the relative value they trade right now. And this is probably why you should only put your money in S&P 500 companies and above. You can see here that S&P 500 is reporting 5.6% year-over-year earnings growth, excluding financials 10.2%. So far higher quality of earnings in the S&P 500. And if we actually look at consensus EPS revisions, normally earnings per share revisions come quite heavily through March FY1. So this right here, and we could see here that this is 2023 and this is the historical average. In 2023 and around March, actually sort of around this September all the way to this March F1 area, we sort of get quite a significant decrease in revisions. We can see here in 2023 was very much the same. It was actually quite steep in both instances. So sort of the position where we are in time right now, December, January, February, March, we get quite a bit of revisions, and then they normally tend to bottom out sort of around the June, September, December area. We are, however, tracking quite ahead of schedule, and BOFA in 2024 see us above the historical average and the 2023 average. So across the board, earnings are coming in better than expected and are expected to be better than the historical average. Now, let's have a look at equity. That being said, are stocks a buy right now? Well, looking at equity risk premium is at 23 years low, and this is just the S&P 500 earnings yield, which I believe is 3.3%, and the T-bill yield, which is 5.1%, and this leaves us at about a 2%, negative 2% ERP equity risk premium. So you're actually losing money by holding equities. But personally, I would actually look at the 10-year. I believe equities are better for longer term investments, and with using a 10-year, the ERP is not quite as bad. It's anywhere from 1 to 2%. Well, it's not great, it's not bad, it's been much worse in the past. One of the reasons why equity risk premium is not that great right now actually has to do with real Fed funds. This is a graph I made up, and it's the federal funds rate minus the personal consumption expenditure, excluding food and energy. And we can see that it has actually spiked up quite significantly in the last 3 months. And that's simply because over the last month or two, yields have actually gone up. Inflation has come down. That means real Fed funds are actually moving higher. The cost of capital is moving higher. And that's why small caps are not doing too well right now. That's why when yields rise, because the inflation backdrop is getting better, small caps, mid caps, these highly levered interest rate sensitive stocks just absolutely dump, because these companies are already so stressed with the debt they have. 40% of them are unprofitable, debt funded, and higher rates is just not good for them, especially higher real rates. And one of the reasons why yields spiked up is because the economic data is coming in significantly better than expected. So we got non-farms last week. You guys know this. We got 353K. It was actually more like 500,000 with revisions. We got like 130, 140,000 revisions. But what was weak is that average weekly hours was actually down on the consensus. Now, Goldman Sachs suspect that this was because of cold temperatures and snowstorms in January that may have depressed weekly hours. And normally they do tend to rebound. They do tend to come back better. Now, this data is not looking good for small caps. That's really going to push yields up if employment data continues to get stronger. If that continues, yields are going to go higher. So we're going to keep a close eye on the employment data throughout the rest of the month of February, because it's going to be really key in what yields are doing. Now, on the topic of wages, despite the inflation surge, real income has actually been above trend since the pandemic began, especially for lower income households, though it has normalized recently from elevated levels. And this is what we're seeing. We're seeing real income gains relative to inflation for the bottom quartile of incomes and the top. And you can see here that this is real income and cumulative deviation of real income. And the bottom quartile is really gaining the most compared to the top quartile. And this is what you want to see in wage gains. This is definitely what you want to see for a stronger economy. And how do you make an economy stronger? You make the bottom half stronger than what they currently are. And you start doing that by increasing their income and going from there. But the problem is consumers might be particularly frustrated with high inflation because the most visible and frequently bought items like food and gas have seen especially large price increases. And Jerome Powell came out on 60 Minutes and said,
some food prices that incorporate the price of commodities, grains and things like that, those can come down. But the overall price level doesn't come down.
And that's the thing that's really affecting people right now. You know, rent, food, gas. Sure, maybe rent may have normalized a little bit, but you know, these items are still historically high in comparison. And that's why a lot of people don't think the economy is in good shape, because they are feeling the effects of inflation despite what they're getting in wage gains. And you can actually see the inflation of frequently purchased items. And that is why Americans' perception of current economic conditions and government economic policies are worse than the usual relationships with economic conditions would suggest. In other words, even though consumers' wages and real disposable income is increasing and outpacing inflation currently, their perception of that doesn't align with what the economic data suggests, and perception is everything. And that's because it takes some time for consumer sentiment to fully recover. That being said, with a strong consumer and a strong economy, what are we expecting GDP to look like? According to Goldman Sachs, we're looking at a Q1 2024 print of 2.8%. Atlanta Now GDP Fed will say something different. different. But all in all, we're looking at GDP for all 4 quarters well above 2%. We're probably looking at 2.3 to 2.4% for yearly GDP in 2024, at least according to Goldman Sachs consensus. Now, supporting strong GDP is actually manufacturing. Manufacturing output strengthened across a broad set of developed markets and emerging markets in January. You could see here that besides Russia, Mexico, and UK, which is flat, they saw a decline in manufacturing. Almost every other market, especially emerging markets, saw an increase, particularly Brazil, Thailand, Canada, Australia, Turkey. And this is what you want to see. Manufacturing is coming out of a recession, not just in the US, but across the globe. And we could see here that global trends, by the way, broad-based manufacturing rebound. The global composite PMI rose by 0.8 points in January to 51.8. So this is the manufacturing right here. Gray is services. Composite is a mix of the two. It's actually rose, and we're finally seeing manufacturing hit just above that 50 level right there. Very, very positive. Finally coming out of this recession that we've been in for the better part of 12 to 18 months. And that's because the underinvestment we've seen in manufacturing for the last 10 years, we're finally getting all the investment back. And that has to do with reshoring. We're finally seeing a huge reshoring, not just in Australia, in Australia too, in Europe, across the world. And especially what happened with COVID, the world said we're no more going to rely on China. And this is why we're getting onshoring and reshoring themes in the global economy right now. And mentions of reshoring have skyrocketed over the last year. And yes, we are coming down, but I do expect this trend to continue and have less of a reliance on, Asian, Indian manufacturing and more of manufacturing in country. Secondly, supporting manufacturing coming out of a recession. We're now in a restocking cycle. And you can see here based on this data that manufacturers and consumers and businesses are increasing new orders as well as stocking inventories. And this is leading to a restocking cycle. Very, very bullish because it just means more money goes into the manufacturing sector. Now, that is manufacturing. Let's talk layoffs. Now, this is challenger job cuts announced. So the size and frequency of layoff announcements are well off the peak, although we have started to see an increase. Now, I did do some research and the average is at about 90,000. So we're still below the average in terms of job cuts. That being said, announcements have increased, as you can see. However, that may be the actual peak of it again, because you can see here that the earnings upcycle should translate to fewer layoffs ahead. Earnings are increasing, not just in the S&P 500, globally across the board. EPS trailing 12-month year-over-year is increasing. We have finally bottomed out, and that means layoffs is likely to do the same. The layoff figures here is inverse, so these should go up as earnings go up. Very, very bullish for the economy. Adding on to that, this is the NYSE composite and the NYSE advanced decline line. You can see here that as the New York Stock Exchange composite is going up, the advanced decline line is going down. So there's a divergence here. I posted something similar with the S&P 500 on my Twitter. Adding on to that, we can see here that the NASDAQ 100 and the percentage of NASDAQ 100 stocks above the 50 DMA, again, diverging. We could see this divergence right here, and that's sort of an early sign that we're either making a top or a bottom, but it doesn't happen instantly. It does take a number of days, weeks, or even sometimes months before that happens. That being said, it is a leading indicator of what's to come. Looking at the equal weight and Russell 2000, very similar situation. Market cap weighted is going up. Equal weight and Russell 2000 is sort of trending downward. There's divergence here between the bigger names in the index and the index as a whole. And here's the advanced decline line for the S&P 500. You can see we're moving up, and you can see that the advanced decline line is moving sideways, even moving down a smidge, and that is not very bullish when you look at it. And normally this does tend to bottom, and again, a very, very strong leading indicator of what's to come. It's not to say we absolutely dump, but maybe we do pull back to some key levels here at 4790, 4700, 4600. Now, let's talk gamma. Not a lot has changed on the gamma profile, and to be honest, on a day-to-day basis, not a lot changes anyway, but what we are seeing is this negative gamma strike here, which is just this pink line right here, which is just a gamma flip zone. So below this line, we're in negative gamma. Above it, we're in positive gamma. It's slowly moving up the tape, which means a couple of things. Either positive gamma is moving up, negative gamma is moving up, or just a lot more negative gammas coming into the tape. That's what that means. And we have seen a bit of volatility throughout the S&P 500 yesterday and today. But that being said, 5,000 continues to remain the core resistance, with a lot of gamma building at the 5,100 strike. But if price does come down here to 48.70, test the waters at 4,900 and we get to this level, expect a lot of volatility, because in negative gamma, dealers buy into buying, sell into selling, whereas in positive gamma, dealers buy dips, sell rips, and it's more supportive, whereas in negative gamma, volatility expands. So the second we get to here, 4,900, 4,870, that's when we're really going to see a lot of volatility come into the tape, guys, and we could really see some vicious downside moves, especially with the negative breadth divergences that we have spoken about. That being said, we are still in a positive gamma condition. 5,000 continues to remain the core resistance, and until we actually get below this 4,870 level, buy dips, sell rips. That is the name of the game, and that is the process we follow on this channel. Now, looking at the S&P 500, up 2.3% for the day, looking very strong as a whole. Looking at trade we actually did on the day though, you could see here that yesterday we had this pretty vicious day, but then dip buyers came in and we actually saw follow through of dip buying throughout the day, even though sellers did try to bring us down in early point trade after that bond auction. We moved higher. That was on great breadth and with a lack of technology participation. What happens when we see technology participate? Do we just go and hit 5,000? Let's have a look at the 5-minute chart. And you can see like we opened, fell down, and you can see we opened, moved lower, and then dip buyers took us all the way. Quite a bit of volatility in intraday trade, but very muted nonetheless compared to yesterday's price action. Either way, was a positive day nonetheless. Not so bullish for the NASDAQ. Looking at the daily chart, you can see that the NASDAQ is looking a bit weak, looking a bit exhausted at these highs. The NASDAQ actually gapped up compared to yesterday, and then we got sold, but there were a bit of dip buyers here towards the end of the day. If we have a look at the 5-minute chart, you can see that yeah, we got sold off pretty much from the start of the day pretty viciously, but then dip buyers did find value in this area to take us higher. But without a lack of technology and semiconductor participation, it's going to be really hard for this index to move higher, since 30% of the index is semiconductors and 50% is technology. Now, looking at the 10-year yield, now the thesis for the 10-year yield was that we're just going to trade in this range, and that's exactly what we're doing. We found support right there, we're seeing resistance right there, and I think that's what yields are going to do up until maybe tomorrow's bond auction. But tomorrow's bond auction is really going to determine what the 10-year yield is going to do. But having a look at every other sector, we could see right here, SPY was up 0.29%, technology com services down. Pretty much every other sector was very, very green. Look at biotech, look at materials, regional banks down on the day. Pretty rough, but all in all, a fairly bullish day. Have a look at China. And we were speaking about Chinese stocks yesterday, that maybe we could have seen that last capitulation bottom we saw like in small cap. Normally when you get like those huge like double-digit down days, that's like you're nearing the bottom. It does look like we're sort of building support around here. This does strike me as value, but you don't really want to buy this first. You maybe want to go take key levels of support, maybe even up here, build a base around here, and then look for higher price action, because you think the stock might not be able to go lower. Trust me, it can go lower. That being said, China is looking like an attractive opportunity, and looking at metrics, I think this index is like 8 or 9 PE. That's very, very attractive when you look at it. So yeah, we're going to keep an eye on China, but I want to see strength first in these markets. Other than that, growth. Other than that, value outperformed growth today. And all in all, the weekly charts are still looking quite strong. The monthly charts are also looking really strong for the S&P 500. And none of this screams to me like we're actually going to break down. This all just looks like very strong, bullish price action, although I would welcome a pullback. Now, data tomorrow for Wednesday. So we got 2 Fed speakers, Fed Kalga, Fed Barkin, and then we got the big 10-year note auction. And then on Thursday, we got the 30-year note auction. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell. Cheers.